Every morning, America wakes up to a number. Sometimes it's inflation, sometimes jobs, sometimes retail sales, bond yields, oil, housing, consumer confidence, or whatever fresh statistic has been chosen to explain your life before breakfast. The market stares at it, politicians weaponize it, news anchors dramatize it, and somewhere in the middle of all that noise, regular people are expected to believe they now understand the economy. But here's the uncomfortable truth. Most people are not reading the U.S. economy. They're reading a weather report written by people, arguing over whether the storm is good for stocks. Because the American economy is not one story. It is several stories happening at once, often moving in opposite directions, and somehow all being called strong at the same time. Stocks can rise while wages feel weak. Unemployment can stay low while households feel poorer. Inflation can cool while everything still feels expensive. GDP can grow while your grocery bill behaves, like it has a personal grudge against you. So when someone says, "Here's what happened in the economy today," what they usually mean is, here's one slice of a giant machine that still doesn't explain why your rent feels like a hostage negotiation. So let's do something more useful. Let's read the U.S. economy the way you'd actually want to read it. If you only had 15 minutes, not like a textbook, not like a trading terminal, and definitely not like a politician giving a victory speech in front of a chart. We're going to treat it like a daily operating system, a machine with a few moving parts that tell you what really matters. What is noise and what hidden pressure is building underneath the headlines? Start with the most important thing in the room. Prices. Not because prices explain everything, but because prices are where people feel the economy first. You do not experience GDP directly. You experience eggs, rent, insurance, fuel, electricity, coffee, interest rates, and that weird moment when you stare at a fast food menu, like you're reviewing a luxury watch catalog. This is why inflation matters so much politically and emotionally. It is the most personal macroeconomic number in the country. When inflation rises, it doesn't just change charts. It changes mood. It changes patience. It changes what people think the future costs. But here's the twist. Inflation cooling does not mean prices go back down. It only means they are rising more slowly. That's the trick hidden in plain sight. If inflation drops from 8% to 3%, the pain doesn't disappear. The pain just stops accelerating as violently. The prices you hate are often still there, standing exactly where they were, like they paid rent in your life and signed a long lease. That's why official progress can feel emotionally fake. The number improves. The experience doesn't improve at the same speed. Then move to jobs. This is the second thing you check every day, even when you don't realize you're checking it. Are companies hiring? Are layoffs spreading? Are wages rising? Is the labor market tight or cracking? Because jobs are the bridge between the big economy and private life. A strong labor market sounds abstract until you understand what it really means. It means employers still need people. It means pay pressure remains alive. It means households still have fuel to spend. And in America, spending is not just important. It is the main character. Consumer spending drives an enormous share of the economy. If Americans stop buying, the machine starts coughing. Now here's where it gets interesting. Good news in jobs can become bad news for markets. That sounds ridiculous until you understand the logic. If hiring stays hot and wages keep rising, the Federal Reserve may worry that inflation will stay sticky. If inflation stays sticky, interest rates may stay higher for longer. If rates stay higher, borrowing gets more expensive, stocks get pressured, and suddenly a strong jobs report can spook Wall Street. This is why economic headlines often read like they were written by someone trapped in a hall of mirrors. Good is bad, bad is good, and everything depends on what the Fed might think about what everyone else might do next. Which brings us to the Fed, the central bank, the institution that has somehow become both the most overanalyzed and the most misunderstood actor in the American economy. The Fed does not directly set grocery prices, fix housing, or create prosperity on command. What it controls is the price of money. More precisely, the short-term interest rate that influences borrowing costs across the system. And when the Fed changes that price, everything starts repricing around it. Mortgages, car loans, credit cards, business lending, asset valuations, risk appetite, even your sense of whether now is a good time to make a big life decision. When rates are low, money feels loose. Borrowing becomes easier. Asset prices tend to inflate. People feel wealthier. Companies hire more aggressively. Startups get funded. Real estate gets hotter. Everyone suddenly becomes a genius, at least temporarily. When rates rise, that mood changes. Debt gets heavier. Monthly payments rise. Marginal businesses feel pressure. Speculation cools. People start using words like discipline and efficiency, which is usually a polite way of saying the free money party is over. And if you want to read the economy daily, you have to understand one brutal truth about rates. They work slowly, but they work everywhere. They are like gravity changes for finance. You may not notice them in one afternoon, but over months they reshape the whole landscape. That's why people keep asking whether the Fed has done enough or waited too long or is about to cut. They're really asking a deeper question. How much pressure is already inside the system, and when will it finally show up? Next, watch the bond market. Not because it's glamorous. It isn't. It has all the visual excitement of a beige conference room. But the bond market is where the economy often becomes honest before everyone else catches up. Treasury yields tell you what investors think about inflation, growth, government borrowing, and future interest rates. If long-term yields rise, borrowing costs across the economy get pushed up. Even if the Fed does nothing that day, mortgage rates can stay high. Corporate financing gets tighter. The government's own interest bill grows uglier. In other words, the bond market can enforce discipline on everyone, including Washington. And that matters more than people like to admit. America has gotten used to debt. Household debt, corporate debt, government debt. Debt is not a side feature of the system anymore. It is the system's favorite fuel. As long as growth outruns the burden, everyone can pretend the arrangement is manageable. But when rates rise and debt rolls over into more expensive borrowing, the math gets less polite. Suddenly, the same debt is no longer just a number. It becomes a monthly reality. And monthly reality is where political slogans go to die. Then look at housing. Because housing is where the American dream and the American spreadsheet collide. The housing market is not just about shelter. It is about wealth, credit, affordability, family formation, construction activity, and the strange national belief that homes are both sacred places to live and excellent speculative assets. When mortgage rates rise sharply, housing freezes in a very American way. Sellers refuse to give up the low rates they locked in years ago. Buyers choke on new monthly payments. Inventory stays tight. Prices don't fall as much as people expect. And everyone ends up staring at each other like a frozen negotiation with granite countertops. This is why housing is such a revealing daily signal. If prices stay elevated despite high rates, it tells you supply is still structurally constrained. If home builders stay active, it suggests demand hasn't collapsed. If mortgage applications weaken, it shows affordability is still suffocating demand. Housing doesn't just tell you whether people can buy houses. It tells you whether the cost of money is colliding with the shortage of real things. Now add consumers. Always add consumers. Because America's economy runs on a simple bargain. Households earn, borrow, spend, repeat. That cycle keeps businesses alive, keeps employment strong, and keeps growth moving. But the daily question is not just whether consumers are spending, it's how they are spending. Are they using income, savings, or debt? That distinction matters. Spending powered by wage growth is one story. Spending powered by credit cards and buy now, pay later is a very different story. One is momentum. The other may be stress wearing good lighting. This is where the uncomfortable math lives. Sometimes the economy looks resilient precisely because households are stretching. They keep traveling. This is why reading the economy properly means constantly separating signal from theater. Signal is when inflation, wages, rates, yields, housing, spending, credit, and productivity begin to tell the same story. Theater is when one impressive headline is used to explain away 5 growing risks. Signal is slow, boring, and reliable. Theater is loud, immediate, and very good at getting quoted. So if you really wanted to read the U.S. economy in 15 minutes each day, here's the practical version. First, ask what prices are doing, because that tells you how painful daily life feels. Then ask what jobs are doing, because that tells you whether households still have fuel. Then check what the Fed and bond market are implying, because that tells you the price of money and future pressure. Then look at housing and credit, because that shows whether the system is absorbing or amplifying stress. Then look at spending and earnings, because that tells you whether resilience is genuine or borrowed. Finally, zoom out and ask whether this entire picture is being held together by productivity and sustainable growth, or by debt, asset inflation, and the hope that tomorrow will be easier than the math suggests. Because that's the real story. Underneath almost every daily economic headline in America, the system has become extraordinarily good at looking stable while shifting pressure around. If inflation cools, debt still weighs. If jobs hold up, housing still strains. If stocks rally, households still feel behind. If growth continues, borrowing often continues with it. The machine doesn't solve tension. It redistributes it. Quietly, efficiently, sometimes elegantly, sometimes cruelly. And that is why the U.S. economy can feel so confusing to smart people. Not because it's impossible to understand, but because it is constantly being summarized by people who benefit from making one piece of it look like the whole picture. The economy is not a headline. It is a layered negotiation between money, work, debt, prices, power, and belief. Belief that consumers will keep spending. Belief that inflation will ease. Belief that rates will eventually fall. Belief that debt remains manageable. Belief that productivity or technology or sheer momentum will carry the load. As long as that belief holds, the daily report can keep sounding manageable, sometimes even optimistic. But the real question is not whether today's number beats expectations. The real question is what kind of economy those numbers are slowly building underneath us. One where growth is broad, durable, and earned.